Hello, everybody. My name is Yaman, and I provide daily updates on Tesla, markets, and technology. Let's get started. Markets are up today. Dow Jones is up 1%, Nasdaq is up 0.3, S&P 500 up 0.5, and Russell 2000 up 1.5%. We didn't get most of the economic data. We're going to talk about the ISM services at the end of today. It's going to put everybody on sleep, so I put it at the end. Crude oil is at $61 per barrel. Treasury yields are up a couple basis points. 10-year Treasury is at 4.11. You can see Palantir is down. We're going to talk about that a little bit. Healthcare is up. Other stocks are kind of mixed on a slow Friday. First, let's start with Tesla. I'm making a prediction. I think the Tesla will soon launch a more affordable model, but it will not be at the promised $25,000 price point, and it will not be autonomous. It will come with lots of hype. It's going to take a while to ramp, and suppose a waiting list that's only due to restricted supply. We've seen Chinese automakers be able to ramp production 3 times faster than Tesla does. So clearly, it can be done. And but I'm sure it's going to take a while. And I don't think anything's going to change. I think the margins will continue to be pressured. ASPs will come down, and not much will change. Tesla hikes lease prices as U.S. electric vehicle tax credit expires. Tesla has raised lease prices for all its vehicles in the U.S. after a $7,500 federal tax credit that helped boost electric vehicle sales expired, according to the company's website on Wednesday. The change follows the net end of tax incentives under sweeping legislation passed by Congress, which eliminated $7,500 credit for the new EV leases and purchases, as well as the $4,000 credit for used EVs effective September 30th. This is the first article that I've seen who actually talks about the $4,000 used EV credit, which is also very material, I think, compared to the, it may even be more material than the new one. Tesla and its rivals had been passing these credits on to customers through competitive lease offers. The monthly lease of EV manufacturers' best-selling Model Y increased to a range of between $529 and $599 from a range of $479 and $529 per month. Prices of all vehicles, however, remain unchanged. The Model 3 lease prices touched a range of $429 to $759 per month from a range of $349 to $699. That's a very material increase, $80 a month at the low end. Demand for battery-powered models is already showing signs of a slowdown after rapid growth earlier in the decade. Sales could drop after the credits dry up, although executives and analysts have warned. Actually, Ford CEO Jim Farley says that the EVs market share could drop from 10% to 5%. And I agree. Reuters reported last month that Tesla's U.S. market share dropped to a near 8-year low in August as buyers chose electric vehicles from a growing stable of rivals, according to data from research firm Cox Automotive. Tesla, which once held more than 80% of the EV market in the U.S., accounted for only 38% of the country's total EV sales in August, according to early data from Cox. That's incredible. That's just amazing. Moving on to other Tesla news, Tesla Energy launches solar and Powerwall lease program. Tesla Energy has introduced a major new financing option designed to make its solar and home battery systems more accessible than ever. Tesla has officially launched a new lease program in the U.S. that bundles solar panels and Powerwall battery system for Tesla, what Tesla advertises as the lowest monthly payment. This addresses the largest hurdle for many homeowners considering a switch to solar or home. I don't think. So this is wrong. Like, this is a article by not a Tesla app. It says addresses the largest hurdle, the high upfront cost. That's not true. There's a lot of lease programs already for solar panels, and I used to think like solar should be on every rooftop, but then I actually looked into getting it with a friend of mine, and the more I dug into it, the more reasons I found not to get it. So I don't think it's the upfront cost anywhere close to the top of the list. By shifting the financial model from a lot, blah, 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 beyond. Okay, we're going to skip this one. Anyway, that's the news. Wall Street hits intraday record highs as rate cut hopes drive momentum. Wall Street's main indices hit intraday record high on Friday as optimism about an imminent interest rate cut by the Federal Reserve boosted sentiment in the final trading session of a week that saw volatility due to the U.S. government shutdown. The federal shutdown, which began on Wednesday, has disrupted the flow of critical economic data, including the highly anticipated non-farm payrolls report that was originally scheduled for release on Friday. It has now been postponed, leaving investors to rely on other indicators that suggest a softening in the labor market, one of which we're going to talk later, keeping bets on the impending rate cut alive. Coupled with the strength in the technology sector, the optimism has so far helped investors look past the federal impasse. The three main indices are on track to notch weekly gains if the current levels hold. The markets focus on a couple of different things instead of the shutdown. One is AI optimism, and then the data that came out this week is pretty supportive of Fed being able to cut rates, according to global investment strategists at Wells Fargo. S&P Tech rose 0.2%, healthcare gained 1.3%, Humana and Danaher added 1.6% and 4.2%, respectively, and were among top performers of the benchmark index. Communication services shares on the S&P 500 fell about 1%, dragged by losses in Meta and Alphabet, which were down 1.2 and 1.4%, respectively. The losses also weighed on the Nasdaq. A gain in banks such as Goldman Sachs and JP Morgan, which rose 0.5% and 1% respectively, boosted the Dow. Meanwhile, BofA Global Research forecast on Friday that the Fed would deliver its next interest rate cut in October instead of December, citing soft labor market data. This is interesting because a couple months ago, the BofA team said they're not going to cut at all this year. However, Chicago Fed President Austin Goolsbee said he was hesitant to commit to a series of rate cuts, with inflation still running above the central bank's 2% target. Data from the Institute of Supply Management showed non-manufacturing activity stood at 50 last month, compared with an estimate of 51.7, according to economists polled by Reuters, capping some early gains. New York Fed President John Williams said central banks needed to be aware that unpredictable changes were inevitable and should strategize to operate in those environments. Investors will parse comments from Dallas Fed President Lori Logan and Fed Vice Chair Philip Jefferson later in the day. In stocks, Applied Materials fell 2.9% after the chip equipment maker forecast a $600 million hit to its fiscal 2026 revenue on broader semiconductor export curbs. Shares of the USA Rare Earth jumped 19.6% after CEO Barbara Humpton told CNBC the company was in close communication with the White House. Advancing issues outnumbered decliners by 2.6 to 1 on the NYSE. Let's dig a little more into the jobs picture. Now, we have a doozy on this at the end of the episode. It's going to put people to sleep, but I think it's interesting. So, the monthly jobs report, along with other close and watch economic data, won't get collected or reported during the shutdown. The government shutdown precluded Friday's release of the monthly jobs report while putting other important federal data gathering and reporting on hold. The monthly employment report from the Bureau of Labor Statistics, a key gauge of economic health closely watched by investors and policymakers, was not released as scheduled this morning, leaving unanswered questions about the health of the U.S. labor market. Through August, the report showed signs of a sharp slowdown in the job market, with revisions released last month showing the economy actually shed jobs in June, while the unemployment rate rose to 4.3% as of August. A report by the payroll processor ADP showed private employers cut 32,000 positions in September, and another report from the global outplacement firm Challenger Gray & Christmas, which we discussed yesterday, showed employers' year-to-date hiring plans were at their lowest since 2009. The longer the shutdown stretches, the bigger deal it will be those awaiting the official jobs data, notably the Federal Reserve. While there's never a good time for a government shutdown, the current moment is especially inopportune. Oxford economist, chief U.S. economist Ryan Sweet told Yahoo Finance, the Fed, which cut rates in September, is closely monitoring the health of the market and will again meet in late October. Meanwhile, the shutdown could also delay the release of September's inflation data, set to be announced October 15, as well as the subsequent 2026 cost of living adjustment for Social Security benefits. Yikes. I suspect that we're going to come back online before this happens. October's jobs data and inflation data, scheduled to be published November 6 and November 10, respectively, could also be pushed back if collection efforts are hampered by the shutdown. With each week you lose, you're losing some time to collect this data, said Stephen Gino, senior U.S. economist at Bank of America. The 16-day government shutdown in 2013 delayed the jobs report and inflation data for 2 consecutive months. October releases were pushed back by about 2 weeks, while November releases were delayed by roughly a week. Still, even with a 2 week delay this time around, the Fed would have time to look at the jobs report before its meeting, Juno said. Okay. Now let's switch to a couple of company-specific news, and then we're going to do a bit more macro after that. Palantir stock falls after report reveals Army network flaws. Palantir Technologies stock fell 4% Friday following a report that a battlefield communication system developed by Palantir and Anduril Industries contains fundamental security problems, according to an internal U.S. Army memo. The memo, reported by Breaking Defense and Reuters, describes the NGC2 platform as a very high risk due to security vulnerabilities that could allow adversaries to gain persistent, undetectable access to the system. The assessment was written by Gabrielle Chiuli, the Army's Chief Technology Officer authorizing official, in September. Among the critical flaws identified in the memo are issues with access control, where any authorized user can access all applications and data regardless of their clearance level, with no logging system to track user actions. The document also noted that third-party applications integrated into the system had not undergone proper Army security assessments, with one application revealing 25 high-severity code vulnerabilities. The NGC2 platform is designed to connect soldiers, sensors, vehicles, and commanders with real-time data on the battlefield. Anduril was awarded a $100 million contract to create a prototype of the system with partners including Palantir, Microsoft, and several smaller contractors. Despite the memo's critique, Leonel Garcia, Army Chief Information Officer and Chiuli's supervisor, said in a statement that the report was part of a process that helped in triaging cybersecurity vulnerabilities and mitigating them. Okay. Apple. Jefferies downgrades Apple on excessive iPhone expectations. Jefferies analyst downgraded Apple. Hold on one sec. Okay, give me 1 second. Jefferies downgrades Apple on excessive iPhone expectations. Jefferies analysts downgraded Apple to underperform from hold in a note Friday, citing what they see as excessive expectations on 18 Fold and replacement cycle, despite raising iPhone unit growth forecasts fiscal year 25, 26, 27 to plus 7%, plus 1%, and negative 1% from 5, negative 3, and 0%. Okay. The firm said that better demand for iPhone 17 is likely driven by no price hike in PPM and an effective price cut for the base, not due to new form factor or tech innovations. Jefferies noted that iPhone 17 PM resale, Pro Max, resale prices remain at a premium 5% to 15% for all variants versus only one variant trading at a premium last year. Stronger China demand is also attributed to deeper price cut at the base model than outside China and the highest trade-in value offered for iPhone 15, 16 among major markets. However, Jefferies warned that more positive sales momentum has inflated expectations on the replacement cycle and prospects of the 18 Fold. They added that the foldable device faces challenges, including price and market size. We do not doubt Apple will be able to make the most beautiful foldable phone in the market, but the question is the TAM of a $2,000 phone. Give me a break. It's not going to be $2,000. The note highlighted competitive pressure from Samsung, whose Galaxy Z Fold 7 display is nearly crease-free, and its thickness unfolded at 4.2 millimeters is even thinner than the iPhone 17 Air at 5.5 millimeters. Wow, that's unbelievable. That's pretty crazy. That is wild. Look at that. The note highlighted competitive pressure from Samsung, whose Galaxy Z Fold 7 display is nearly crease-free and its thickness unfolded at 4.2 millimeters is even thinner than the 17 Air at 5.5 millimeters, with the industry expectations of annual volumes of no more than 3 million units. Jefferies concluded that Apple's current valuation prices in overly bullish iPhone outlook, noting that even a $100 price hike for the iPhone 18, their discounted cash flow model remains little changed at $205 or $800 billion below the current market cap. They said this implies demand for the foldable iPhones 100% above Jeff E forecasts, underpinning the downgrade. Okay, let's switch to another Jeff. Bezos says AI spending boom is a bubble that will pay off. Amazon chairman Jeff Bezos said that the spending on artificial intelligence resembles an industrial bubble that could lead to lost investment, but will also make society better off. Quote, when people get very excited, as they are today about artificial intelligence, for example, is every experiment gets funded. Every company gets funded, the good ideas and the bad ideas, Bezos said, pointing to companies getting billions of dollars of funding before they have a product. Quote, investors have a hard time in the middle of this excitement distinguishing between the good ideas and the bad ideas, end quote. So he likened it to the internet bubble in the 90s. So things bursted, people lost money, some capital was lost, but a lot of good came out of it in the following decades. Another idea by Jeff Bezos. Data centers in space. Jeff Bezos thinks it's possible. Amazon founder and executive chair Jeff Bezos said on Friday, gigawatt scale data centers will be built in space within the next 10 to 20 years, predicting they would eventually outperform Earth-based ones thanks to the abundance of uninterrupted solar energy. The number of these enormous centers, which store computing infrastructure, is growing exponentially as the world increasingly uses AI and cloud computing, driving a surge in demand for electricity and water to cool their servers. One of the things that's going to happen in the next, it's hard to know exactly when, it's 10 plus years, and I bet it's more than 20 years, we're going to start building these giant gigawatt data centers in space, Bezos said during a fireside chat with Ferrari and Stellantis chairman John Elkman at the Italian Tech Week in Turin. The concept of space-based data centers is gaining traction among large tech companies as the energy needs to maintain such operations on Earth are growing sharply. These giant training clusters, those will be built in space because we have solar power there 24/7. There are no clouds and no rain, no weather, Bezos said. We will be able to beat the cost of terrestrial data centers in space in the next couple of decades. Bezos said the shift to orbital infrastructure is part of a broader trend of using space to improve life on Earth. Quote, it already has happened with weather satellites. It has already happened with communication satellites. The next step is going to be data centers and then other kinds of manufacturing, he said. However, hosting data centers in space has its own challenges, including cumbersome maintenance, limited scope for upgrades, and high cost of launching rockets, as well as the risk of failed rocket launches. Interesting ideas. And one more, Amazon. Exclusive. Amazon loses devices VP and member of elite CEO advisory just days after launches. Reuters exclusive. Just days after putting on its annual devices and services showcase, Amazon is losing a vice president who helps oversee the division. Rob Williams, vice president of device software and services and a member of the elite internal group known as the S Team, advising CEO Andy Jassy, left his post and will step down entirely from Amazon's at year's end, according to a memo sent internally Thursday and reviewed by Reuters. Amazon confirmed the memo after a query from Reuters without providing additional detail. Quote, Rob has had a big impact on the software experiences of nearly all products we've created and shipped, said Panos Panay, the senior VP of Device and Services in the memo. He said Williams decided to retire from Amazon, but Reuters could not learn his future plans. Golfing. Panay also announced the consolidation of several teams in his unit, including moving the Alexa Smart Vehicle team into the broader Alexa group. He said the changes were effective Thursday, including the elevation of Tapas Roy, the previously vice president overseeing the Fire TV product and engineering, to Williams' former post. Williams will remain an advisor to Panay and on the S team through the end of 2025, according to the memo. It is rare for S team or senior leadership team members to depart, as the group is regarded as a badge of honor within the company with unique access to CEO. Williams, who joined the 29-member S team in late 2022, and worked at Amazon for 12 years, did not immediately respond to requests for comment. He attended Amazon's Devices event on Tuesday in New York, where the Seattle firm showed off an array of new products like refreshed Echo Voice Assistant speakers, color Kindle e readers, wow, and Fire TV sets with improved screen quality. Interesting. Okay. Switching back to macro. This is the last couple of things we have. If you're not interested in macroeconomics, you may leave now. Fed's Goolsbee a little wary of front loading too many rate cuts. Chicago Fed President Austin Goolsbee on Friday said he was hesitant to commit to a series of interest rate cuts with inflation still running above the central bank's 2% target, echoing the concerns of several of his peers about the persistence of inflation for services. The Fed Goolsbee said in an appearance on CNBC was in a bit of a sticky spot, with recent data showing an upswing in services inflation while payroll job creation has been weakening. Quote, "You're getting a deterioration on both sides of the mandate at the same time," end quote, he said. Quote, "If the inflation looks like it's going to be transitory, and I say the word with some fear, then I think employment side of the mandate would be dominant. But you see this uptick in inflation, and particularly an uptick in services inflation, which is probably not coming from tariffs. I'm a little wary about front loading too many rate cuts and just counting on the inflation going away," end quote. The Fed cut rates last month by a quarter of percentage point to a range of 4% and 4.25%, and rate futures markets are positioned for two more such reductions at the central bank's remaining two meetings this year. Nonetheless, several of the Fed's regional reserve bank presidents have, like Goolsbee, been voicing concern about inflation's persistence and have been reluctant to endorse expectations for a series of rate cuts ahead. Goolsbee appeared at a time when ordinarily the Bureau of Labor Statistics would have released its monthly report on the U.S. employment situation, but publication has been suspended because of the federal government shutdown that began on Wednesday. All benchmark economic data reports from the BLS, Bureau of Economic Analysis, and Census Bureau have been put on hold during the closure. Job growth has been slowing through the year, in large part because President Donald Trump's crackdown on immigration has stymied the growth of the workforce, but there has been little evidence so far of widespread layoffs, and while the unemployment rate has edged up, it remains at a historically low level. The Chicago Fed recently launched a model that estimates the unemployment rate, and its latest update on Thursday showed the jobless rate in September was likely unchanged at 4.3%. Thus far, it continues to point to a pretty stable labor market in my view, Goolsbee said. So he's not ready for another cut in October, but I think majority is. So okay, final piece, and this is going to take a little bit. September 2025 ISM Services PMI report. Let's take a look at this. There's a lot of detail in these things. Services PMI came in at 50%, business activity index at 49.9%, new orders at 50.4, employment index 47.2, which is amazing, 47.2. Okay. So that's still below in September of 50. And services, I think, is most of the US economy now. I think it's like 80 plus percent. So it's very, very important number. SPY deliveries index at 52.6%. It kind of, I don't think you guys can see this, but just listen to my beautiful voice. Economic activity in the services sector was unchanged in September, say the nation's purchasing and supply executives in the latest ISM Services PMI report. The services PMI reading of 50% was at the break-even point between expansion and contraction for the first time since January 2010. Okay. Break-even point for the first time since January 2010. So that's 15 and a half years, almost 16 years. Yikes. The report was issued today by Steve Miller. Too many acronyms to read. Quote, in September, the services PMI registered an unchanged reading of 50%, 2 percentage points lower than the August figure of 52%. The business activity index moved into contraction territory in September, okay, 5 percentage points lower than the reading of 55 in August. This is the first time the index has entered contraction since May 2020. The new orders index remained in expansion in September with a reading of 50%, down 6% from August figure of 56%. The employment index remained in contraction territory for the fourth month in a row and the fifth time in the last 6 months. The reading of 47% is 0.7 percentage points higher than the 46.5% recorded in August. Quote, the suppliers deliveries index registered 52.6%, 2 percentage points higher than the 50% recorded in August, and its highest reading since February. This is the 10th consecutive month that the index has been in expansion territory, indicating slower supplier delivery performance. Supplier deliveries is the only ISM PMI reports index that is inversed. A reading of 50% indicates slower deliveries, which is typical as the economy improves and customer demand increases. The prices index, this is another important one given the context of these days. The prices index registered 69.4%, so it's off the charts in September, a 0.2 percentage point increase from August reading of 69.2%. The index has exceeded 60% for 10 straight months, its longest such streak since 30 consecutive readings above 60% from October 2020 to March 2023. Okay. So that doesn't bode well for inflation reports that will probably not be released because of the shutdown next week. I think it's next week. Yeah. The inventories index dropped into contraction in September after 3 months of expansion territory, registering 47.8%, a decrease of 5 percentage points from August. The inventory sentiment index expanded for the 29th consecutive month, registering 56%. The backlog of orders index was in contraction territory for the 7th month in a row. 10 industries reported growth in September, 2 fewer than in August, while the number of reporting contraction increased from 4 to 7. So it's getting more widespread. The September reading of 50% is 2 percentage points below the 12-month average of 52%. The 12-month average figure is the lowest since September 2024. September services PMI level returned to numbers very similar to May and July, with weakness in business activity and continued weakness in employment. The recovery in the backlog of orders index is a reading indicating slower contraction was a positive signal, as was continued expansion in the new orders index. Commentary in general indicated moderate of weak growth, with more isolated observations of supply delivery challenges. Employment continues to be in contraction territory, thanks to a combination of delayed hiring efforts and difficulty finding qualified staff. Talent services industry is reporting growth in September. Listed in order are accommodation of food services, healthcare and social assistance, other services, information, public administration, educational services, wholesale trade, finance and insurance, transportation and warehousing, and utilities. The 7 industries reporting contraction: mining, agriculture, forestry, fishing and hunting, construction, managerial companies and support services, professional, scientific, and technical services, retail trade, real estate, rental, and leasing. Now, some anecdotal evidence from respondents. Quote number 1: we're beginning to see the impact that tariffs impact our business, particularly in food products from India, China, Southeast Asia, coffee from South America, and apparel and electronics from Asia. Our year-over-year cost increases are getting progressively greater. 2. New residential construction continues to struggle in a tough market. Housing values remain high, and tariffs are beginning to be passed through materials that are metal-based. The pace of housing starts has been stagnant to slightly declining as we head out of the summer building season. 3. Pharmacy costs continue to rise, and medical cert devices are being held at bay mainly due to contracts and continuing negotiations where we have 2 to 3 sources for a given product. 4. Demand for AI and cloud infrastructure remains very strong. Our primary focus this month was on increasing production throughput to begin clearing the significant order backlog built over the summer. While new order intake has stabilized at a high level, the overall business outlook remains positive. We are still facing significant supply chain challenges, especially for advanced semiconductors and power components, with lead times remaining extended. Price pressures are still present, but have not worsened compared to the previous month. 5. Client demand in professional services remains steady, though decision-making timelines are lengthening due to continued economic uncertainty and interest rate concerns. We're also seeing modest upward pressure on labor costs, which impacts both our internal resourcing and supplier pricing. 6. Growing apprehension regarding the state efforts to eliminate property taxes that are major revenue for source for local governments, and continuing concern about future economic conditions, inflation tariffs, and either impact on increased prices. 7. The overall housing market remains stagnant, which has forced our company to be hyper vigilant about costs. However, we are growing and increasing our market share despite the headwinds. Tariffs continue to inject an unnecessary level of uncertainty across the broader economy, and costs are now beginning to increase with the full effect of the tariffs now coming into play. 8. Costs overall have stabilized, and we've not seen any interruption in sourcing or shipments. This is for retail trade. 9. We've had more tariff change last month than in previous months for utilities. And 10. Business conditions continue to soften, even in markets that have historically been more resilient. Demand is simply weak. Wholesale trade. You can see more detail of the indices changes from August, trend, number of months, and also the manufacturing PMI is here as well. I mean, the couple of ones that are important are right now prices, obviously. Services are increasing. You can see high and increasing. Yikes. And 100 months of trend of high prices. Damn. And then for manufacturing, 6 months, it's still elevated, but that one decreased on manufacturing for prices paid. And new orders on the manufacturing front are lower than 50, and services sharp drop from August to September, but still slightly positive at 50.4 for new orders. That's a big drop in 1 month. I mean, I think that probably should be a bigger story than what I've seen. The 6 percentage point change in the new orders index from August to September, and then the high prices. So stagflation story. This is a support for stagflation story. Commodities up in price. Aluminum. I'm not gonna read all this. Down in price. Some energy stuff. Diesel, gasoline, lumber. Commodities in short supply. Labor for construction. What? That's interesting. That's surprising. Levels for the services PMI. Okay. Business activity. More detail. New orders. More detail. Let's read the employment section. Employment activity in the services sector contracted in September for the 4th month in a row. The employment index registered 47.2%, up 0.7 percentage point from the August, and equal to the June reading. Comments from respondents include, we have lost employees due to normal attrition and are pausing backfilling these positions at this time. And AI is positively impacting resource productivity. Interesting. So 4th month in a row contraction, which lines up with the negative readings in June, July, and I think if September was released today, it would have been negative as well, from BLS. And then, so 2 comments here: we have lost employees due to normal attrition and are pausing backfilling these positions at this time. So new hirings are basically paused, and job losses are due to normal attrition, so no layoffs. So that lines up with all the data that we had seen before the shutdown. And AI is positively impacting resource productivity. Okay. The 6 industries reporting an increase in employment in September listed in order. We're going to skip that part. Supply deliveries, we're going to skip that. Inventories, let's go to prices. Prices paid by service organizations for materials and services increased in September for the 100th consecutive month. The price index registered 69.4%, a 0.2 percentage point higher than the 69.2% recorded in August. The September reading is the index's second highest since October 2022. That's wild. And its 10th straight month above 60%, but the 35th in a row below 70%. Okay. 15 of the 18 service industries reported an increase in prices paid during the month of September in the following order. I'm guessing this is just levels. So accommodation of food services still very high. Management companies and support services, public industries, information, construction. Okay. And backlog orders, new exports, orders, imports, inventory sentiment, whatever that means. All right. And then there's some methodology for those, but it's more of a diffusion index than anything else, I think. All right. Now, on that note, thank you very much, everybody, and enjoy your weekends. Subscribe to the YouTube channel where I publish lots of short videos. I'm going to be publishing long form videos as well. I'm going to focus on the YouTube channel quite a bit going forward. And I highly recommend subscribing there. And then let's keep in touch and take care.